Hello everyone. Welcome you all to the introduction session of Investment Management. I am Impa Bilyappa, Associate Professor, Department of Management Sciences, Maharaja Institute of Technology, Mysore. Before knowing about the subject, let's know about our college and the department. Our college vision is to be recognized as a premier technical and management institution promoting extensive education, fostering research, innovation, and entrepreneurial attitude. Our college mission is to empower students with indispensable knowledge through dedicated teaching and collaborative learning, to advance extensive research in science, engineering, and management disciplines, to facilitate entrepreneurial skills through effective institute industry collaboration and interaction with alumni, to instill the need to uphold ethics in every aspect, to mold holistic individuals capable of contributing to the advancement of the society. This was our college mission. Now let's move on to the department vision, which is to contribute the nation with disciplined, responsible, professional, and skilled management graduates. Our department mission is to provide excellent management education for rural and urban students, empowering them with the capabilities to become valuable citizens contributing continuously to the global business management. As of now, we have discussed our college vision and college mission. Let's discuss and also we have discussed the department vision and mission. Let's discuss the outcome of MBA program. So once you finish your 4 semesters, what will you be learning? What will you be able to? First, you'll be able to apply the knowledge of management theories and practices, what you've learned during the course, to solve any kind of business problem. It also fosters your analytical and critical thinking abilities for data-based decision making. It also develops an ability of value-based leadership. It also you will be able to understand, analyze, communicate global, economic, legal, and ethical aspects of business. And also the ability will lead them to lead themselves and others in the achievement of organizational goals, contributing effectively to the team environment. So these are certain outcomes. At the end of your 4th semester, you'll be able to inculcate all of those. So this was just a brief intro about our college department and about the program. Let's move on to the subject, which is investment management, code 18 MBA FM 302. This is the specialization subject in finance which you get it in 3rd semester, and this is an interesting subject, and practically this can be applied to the real-time trading. This course of investment management aims at understanding various investment avenues that help you to design and reach your financial goals in the global context. So various investment avenues, we can say that you can invest in stocks, gold, debentures or bonds, whatever you can think of. It might be commodities also, rice, ragi, wheat, pulses, jowar. All these are all the different avenues in which you are able to invest even now, but you'll enhance the knowledge by learning the subject. The theories underlie strong investment decision as well as practical real world skills to apply the knowledge while discussing investment proposals with the stakeholders or manage underlying assets. Like if you have after your MBA course, once you join the organization or if you join as an stockbroker, then you'll be able to advise your customers or your clients about the best portfolio which can be created, which will help them to generate income for themselves, and it will also generate income for you too. It starts by developing the global understanding of financial markets and its impact on their rational and irrational behavior in finance at a macro level and micro level. If you understand the financial knowledge, if you understand the financial market in and around the country, that will help you to know the influence of other markets on the country's market. The investment management industry manages hedge funds, mutual funds, private equity, venture capital, and other financial avenues for third party. As I've already told you, it generates income for the third party, that is your clients or customers, which include companies, pension fund, endowment insurance companies, private banks, non-profit organizations, or individuals. They might be any of your clients. So it will generate income for them as well as for yourself. The market and regulations have changed significantly over the past 10 to 20 years, where during a duration of just 10 years, we have seen the Sensex booming up more than 500%, which was 8,000, it rose up to 32,000. There is a vast difference within just a span of 10 years. So it might be due to the data technology, which is increasingly important in the investment management and its evolution, we can say. Okay, the investment management deals with building and managing of portfolios. Portfolio means that is a group of securities which you combine in order to make an investment. So we say, don't put all the eggs in one basket, put it in different basket. So that is the concept of portfolio, with structural time base by assessing the risk and return of different stocks. So if you want to make an investment, then you have to assess the risk and return of a particular stock, so that you can invest in the portfolio or stock where the return is high and risk is less. It also provides advice, solutions, and products designed to help the clients to deliver the expected outcomes, as the expectation of the customers will be different. Some want the stocks which are safe, some want stocks for the purpose of liquidity, some want it for the purpose of return. So each customer or client's needs and wants will be different. So based on that, different portfolio or according to the client, customization can be made in this investment. So what is the use for y'all about this subject? At the completion of this course, the student will understand the capital markets and various instruments of investment, and will be able to assess the risk, return associated with the investment, and the methods to value its securities. So you will be able to understand the capital market, various instruments of investment. You will be able to assess the return. You'll be by using the different methods of valuing the securities. The students will be able to analyze the economic condition of the country, the industry, which industry is in boom, which industry is in recession, which industry is in what stage of the business cycle. These all will be, you'll get a knowledge or insight about it. And also you will be able to understand the company framework, about the profitability of the company, the financial position of the company. You will be able to assess the worth of the company for investment management. And also you can learn the theories of portfolio management, like what kind of tools you use in order to assess the portfolio risk and return, and to see what kind of investment should be made and which time to make an investment, what is the right time to make an investment, and also what amount should be invested, and also at what time you should exit. Entry and exit to the market plays a very important role in investment management. The right time to exit and the right time to entry is very important in IM. So let's say the objectives of the course. What is it planning to teach you all? What are the objectives of the subject, that is the course? It makes us to understand the capital markets and various instruments of investment. It helps us valuing the equity, debt, and mutual funds. That includes almost all the parts of the stock market, and to learn the theories of portfolio management. These are the basic three objectives. At the completion of the course, you will be able to understand. Okay, coming on with the syllabus, this course comprises of 6 units, which individually some part it is theory and some part of it is problem. Mainly it is problem oriented subject. The weightage given to this subject is 50-50. So let's know what is included in all these 6 units. Starting with unit 1. Unit 1 tells you about the investment and security market, like investment in the sense what are the attributes of investment, if there, what is the difference between economic investment and financial investment, how it is different from investment and speculation, features of good investment. To tell you about, if you say attributes, just now I told you that your client or customer or maybe you, you have your own priorities. Based on that, you can plan your investment or security. So on the basis of your planning, for example, if you say the attributes, it might be if you're willing to invest in safety oriented securities, or if you are interested in getting higher income, or if you want to hedge against the inflation, or you want to invest in securities which is having liquidity, or you want to invest in securities where the risk is less. So these are all the different attributes where you can see that based on the client or customer's preference, you can make an option. Okay, that is about the attributes. Then coming to the economic and financial investment. So what do you mean by economic investment? Economic investment is related to the countries, it might be the inflation. Just now I gave an example. Based on that, if you make an investment, then it's an economic investment, or it might be the financial, where the value fluctuates like stocks, shares. In that, if you make an investment, then it's a financial investment. Or else you learn the difference between investment and speculation, where investment means it's legal, whereas speculation is not that legal, and you make an short term speculation. Speculation is for shorter period, and investment is for a longer period, where you make huge investments in speculation, whereas you make your own funds in investments. Normally for speculation you use borrowed funds. So this is how the difference between investment and speculation are categorized. Then you can say features of a good investment. So just now I've quoted the attributes. If you have that, then it's a good investment. The return should be more, the risk should be less, liquidity should be more, safety should be more, then it should have an hedge against the inflation. If you have all these in positives, then you say that these are all the good features except the risk concept. Risk should always be less. That's the positive for the good investment. Then you can say investment process. So investment process, you have 5 divisions, where you first understand your own objective. You see that whether you have the knowledge or whether you have to rely on someone to make an investment. Then you select the, you make in company analysis, industry analysis and economic analysis, and after that, making an analysis, you diversify your portfolio, then you evaluate your portfolio. This is nothing but the process of investment management. Then you have the financial instruments category. In financial instruments category, you have money market instruments, capital market instruments and derivatives. So what are these money market instruments? Money market instruments are normally for short term. It might be treasury bills, it might be commercial papers or certificates of deposit within a span of 1 year, which measures within 1 year. That is known as money market instruments. Then you know about the capital market instruments, which are long term, like you have your shares, debentures, bonds, long term fixed deposit. These will learn about the capital market instruments. Then comes the derivatives. Derivatives, it is the value derived from the underlying asset. Like it might be the gold, it might be the commodities. I've told you about the rice, ragi, wheat, jowar, pulses, anything. Okay, those are the commodities. Based on that, the value is derived. You have your future contract, forward contract. All these are the derivative concepts which we'll learn in this unit. And also we learn about the security market. So if you have to make an investment, you have to have the knowledge about what is an investment and how it is important and what are all the markets available and what are all the investment avenues available. All this knowledge is very important. So when we say security market, the security market is segregated into two markets, that is the primary market and secondary market. So primary market means where if a company is issuing the shares for the first time, if it's going for public, then we call it primary market. So in primary market also you can buy the shares from the primary market. It is through the banks, you take the application of a particular company and you fill that and return it back, then the shares will be allotted, then the money will be collected. Once the complete process of primary market has been done, then we transfer the shares to the secondary market for trading. That is the concept. So here primary market is the initial market where the shares will be issued for the first time, and then the same shares are traded in the secondary market. That is known as where we deal about the stock exchanges. So you need to understand how the prior shares are issued in primary market, then how it is being converted into or transferred into the secondary market. That has been told in the first unit. Then we know about the stock market indicators. So stock market indicators, here you have different types of stock market indices, like in India you have Sensex and Nifty, where Sensex is the indicator of BSE stock exchange, that is Bombay Stock Exchange, and Nifty is the indices of National Stock Exchange. These two are the major stock exchanges in the country. We'll also learn about these stock exchanges, Indian stock exchanges, and also we understand how these indices is calculated. We say Sensex is 33,000, 34,000, or we say Nifty about the Nifty. Like this, when we quote about these Sensex and Nifty, where does the value come from and how many stocks, like for example for the composition of Sensex stocks, it is 30 topmost companies which has the good market capitalization and also which are actively traded. And in case of Nifty, if you have to do a composition, then it's of 50 stocks. Like that only you have Nifty 500, Nifty 200. Like this, you have different composition of stocks. But the famous one is Nifty 50. Okay. So like this, in the first unit, you will be understanding the knowledge about the stock market. Like what do you mean by an investment? What is a share? How an investment need to be made? Why an investment need to be made? Where the W's and H's, who, what, why, how, and all these questions, W's and H's are answered in your first unit, where you get a knowledge about the investment management. So let's move on to the second unit. Unit 2 deals with the risk and return concept. So when I told you about the meaning of investment management, when I told you about the objectives of investment management, I had told you about the risk and return concept. So what do you mean by the risk and return concept? Return means if you make an investment in the share, what are you getting back? How a return is calculated? So return is calculated based on two parameters. One is the capital appreciation, another one is the dividend. So these two are the basic parameters. For example, if you are buying a share at 10 rupees, this is just an example. If you are buying a share at 10 rupees, then you are selling the share at 15 rupees. Then the difference is 5 rupees. This 5 rupees is nothing but your capital appreciation. And if you have to tell what do you mean by dividend? So dividend is the return which you get out of the profits of the company. Every year when the company makes its sales, if it's a product oriented or service oriented industry or a company, then you sell your service or your product. Once you sell your service and your product, then you get the profit. At the end, after paying all the interest and the day expenses, working capital, everything is being paid, the leftover profit is being divided among the shareholders. And this division of profit, we call it as dividends. Okay, so return comprises of two components. One is the dividend and another one is the capital appreciation. Okay, so this was about the return, and next is risk. Okay, risk is a concept where to get a higher return, how much risk you have to take. Higher the risk, higher the return. Lower the risk, lower the return. So in this components of risk, we learn two types of risk: systematic risk and unsystematic risk. Where systematic risk is uncontrollable, like market risk, purchasing power risk, interest rate risk. This affects everyone and you can't play any role in this, neither you can control it. You can try to minimize, but there are no such tools to completely avoid the systematic risk. Then you have the unsystematic risk. In unsystematic risk is the controllable risk, where you can try and control the risk. You can completely minimize your risk, that is your business risk or financial risk. You can take measures to do it. So in this module, the first unit was completely about the theory. Unit 2 comprises of theory as well as problems. Here we'll do problems related to risk, related to return, and individually as well as the portfolio and combination, and what is the relationship among them and the variance, and you'll also learn the measures of doing risk, that is standard deviation, beta. All these we are going to learn in the unit 2. Let's move on to unit 3. So unit 3 is about the valuation of securities. So valuation of securities, I have told you that while telling about the objectives, we learn about the stocks and also we'll learn about the valuation models of debentures. So this unit is also a combination of theory as well as problems. In this module, first we'll learn the theory about what is a bond, what is the feature of a bond, what kind of bonds are there, like fixed coupon bond or zero coupon bond. You have different kinds of bonds which you'll be learning here, and also you'll be learning the kinds of the different determinants of interest rates, what all influences, time influences, the number of period, that is interest rate influences. All these are the influence or determinants of interest rates which you'll be learning. Then you'll be learning the strategies, bond management strategies. You have active strategy, passive strategy. Those strategies you're going to learn here. Then you'll be learning about the preference shares and equity shares. Preference shares are, see, the difference between debentures, preference shares and equity shares are, first, the debenture holders are given more importance because they are treated as the debt. The debentures is treated as a debt and interest is being paid. So out of the profits what you get, first the payment will be made to the debentures, and these are all the long term capital market instruments. And after debentures, then they'll go to the preference shares. So preference shares in the sense where the preference is given regarding dividend payment and also at the time of company winding up. Next, after the debentures are being paid the interest and amount is settled, then they come to the preference shareholders, and these preference shareholders get the dividend, and in times of liquidation amount is settled, then leftover profit is being shared among the equity shareholders. The difference between preference and equity is, in equity shares, the dividend rate is not fixed. So whatever leftover profit is there, completely it is distributed among the shareholders. Whereas preference shares, they have fixed, like 9% preference shares, 10% preference shares. So the percentage of dividend payment in the share of profit is fixed and they get only so much. So this is about unit 3, where we'll learn about the valuation of bonds, when we'll learn the valuation of preference shares and equity shares. We have models like H model, two-stage model, constant growth model, three-stage model. Like this, we have no different models which we'll be learning in unit 3. Coming to unit 4. Unit 4 comprises of 3 components: economic analysis, industry analysis and company analysis. So this is also known as EIC approach. E for economic, I for industry and C for company. Coming on with the industry, before dividing that into categories, here we learn about the economic concepts. So in economic category, we learn about the macroeconomic factors like the inflation rates, the demographic factors, monsoon and agriculture, and the GDP. Then you have your growth rate, unemployment rate, employment rate. All these will influence the economic factors, and overall for all the industries and companies, these economic factors will make the common influence. Okay, coming on to the next one, which is industry analysis. So this is on a category wise. For example, if you take cement industry, cement is stated as an industry. In cement industry, you have ACC Cement. So these are companies. Birla Sun Life. Like this, you have different companies which combinedly we call it as an industry. Group of companies will make an industry. You have Tata Consultancy, Wipro Consultancies, Infosys, all these will make an IT industry. So this a group of companies of similar type will make up to the industry. So this industry analysis is also made where we are going to assess where how the industry is in, like how what is the industrial cycle, in which cycle it is, whether it is in introduction or whether it is in growth or maturity or decline. We are going to assess that, and this analysis is common for all the companies in that particular industry. Okay, that is industry analysis. Then is company analysis. In company analysis means each company will be analyzed individually based on their management capabilities, financial capabilities, and also their working nature, working environment, their financials, that is how are they being profited from past years, or are they in the loss, that is being assessed in the company analysis. And this actually is being divided, these analyses are being divided into fundamental analysis and technical analysis. In unit 4, it is a combination of two concepts, that is fundamental analysis and technical analysis. So fundamental analysis are the basic analysis to calculate the intrinsic value of the share, means the real worth of the share, which includes your industry, economic and company analysis. But your second category, that is technical analysis. Technical analysis means usage of tools and techniques are used here in order to assess the share price based on the historical performance. It's like calculating the trend, like how it was previously, whether we have a saying, no, history repeats itself. So with that notion, technical analysis has been framed where we use different tools of technical analysis in order to understand what is the price, real worth of the share, and when to buy, when to sell. So in this technical analysis, we have different tools, like we have Dow Theory. The main hypothesis of Dow Theory is to the history repeat itself. It's just a tool to face the market and not to beat the market. Means you'll only be able to make an investment, but there is no surety that definitely you'll make profits. Okay, that is about the Dow Theory. Then Elliott wave theory. So Elliott wave theory runs in 3366 concept, where 5 ups and 3 downs, or 5 downs and 3 ups during the bull and bear markets. Then you have different chart types, like you have head and shoulders chart, V form chart, flag chart. These are all the patterns. In charts, we have patterns. Charts, like you say that line chart, bar chart, pie chart, sectored pie chart. Then you have a point sign figure chart, Japanese candlesticks. Like this, you have different kinds of charts, and also you have patterns in that. Patterns, as I've told you, it's head and shoulders, V form pattern, flag format, triangle format. In triangle pattern also you have symmetric, unsymmetric. Like this, the chart pattern is also very widely divided. And then you have moving averages. We know about, in statistics, when we have learned about the 3 days moving average, 5 days moving average. Here it will not be in 3 days, 5 days. It will be 200-day moving average. It is again segregated into short term, middle term and long term. The long term moving average is 200-day moving average. For 200 days the closing prices are taken and moving averages are calculated. Then you have ROC, that is rate of change. Then you have RSI, relative strength index, to know what is the right time for investment and what is the right time to exit from the market. Then you have other market indicators like oscillators, odd lot trading. These are all the other market indicators which we are going to learn in this unit. This unit completely comprises of only theory. Okay, no problems in this. Even though there is financial analysis and ratio concept, to do the financial analysis, you have to do the ratios. Even though that concept is there, it does not cover any problem for your exams. Let's move on to Unit 5. Unit 5 is related to modern portfolio theory. So this is till now what we have discussed as almost the traditional pattern which we had followed. Modern is comparatively slightly modern towards the traditional. And in this modern portfolio theory, we learn about the Markowitz theory, Sharpe's single index, where he tells how an optimum portfolio is calculated, how a risk return is calculated. Same, the risk return concept is already there. The risk return only is calculated, but using different models and methods. And you have your capital asset pricing model. You learn about the security market line. Then you learn about the capital market line. You learn about the arbitrage pricing theory. Arbitrage pricing theory is nothing but the difference the difference in the profit which you get when you take the advantage of two different markets. That we call it as arbitrage pricing theory. And you learn the comparison of what is a capital asset pricing model, or what is the difference between capital asset pricing model and arbitrage pricing model. So this is about Unit 5. Then the last unit, which is Unit 6. Unit 5 is also a combination of theory and problems. Unit 6 is also a combination of theory and problems. So complete theory, it is only in two units, that is Unit 1 and Unit 3. Unit 4. Unit 6 is segregated into three divisions: market efficiency and behavioral finance, portfolio management strategies, and portfolio performance evaluation. So here, market efficient and behavioral theories. So here we learn about the random walk theory. Random walk theory is segregated into three parts, where we say weak form, semi-strong form, and strong form. So if you say that all the information is going to influence on the market, then it's strong form. If none of the information is going to influence the market, then weak form. So these are the forms, or which we call as random walk theory. Then we learn the efficient market hypothesis. So we draw a chart in the umbrella form, where outside the umbrella, if you get the stocks, we connect the external points. When you connect the external points, then the outer stocks are more profitable and the internal stocks are not that profitable when compared to the outer circle. That is about the efficient market hypothesis. Then we learn about the behavioral finance, where we try to understand the psychology of the investors. At what time they are going to invest, at what time they'll try to withdraw the shares or withdraw the investment. We are trying and analyzing their investment pattern and the behavior of an investor. That we'll learn on the behavioral finance. Then portfolio management strategies. We have two kinds of portfolio management strategies: active portfolio management strategy, passive portfolio management strategies. In that also we learn the formula plans, we learn how to revise a portfolio, we learn the strategies of the portfolio revision. So this is about the strategies which you use in order to sustain in the market. And then comes the portfolio performance evaluation. So while telling the objectives, I told about three investment opportunities: shares, debentures, and mutual funds. Shares, debentures we will have discussed in Unit 3. Unit 6 tells you about the mutual funds, where we are going to assess the performance of the mutual fund. So how do you assess the performance of mutual fund? We have three models in that: Sharpe's model, Trainer's model, and Jensen model. Using these three models, we are going to calculate or evaluate the performance of mutual funds. So in the 5th and 6th module, we are going to understand or will be able to construct the portfolio, that is which is giving you more return and less of risk. Okay, which is an important part in order to understand what kind of investment or where the investment should be made and what amount should be invested. So this is about the syllabus from 1 to 6. and last we'll know what are the outcomes. So at the end of your third semester, in learning this subject, previously we learned what are the outcomes of the program, means after all the 4 semesters what will you gain. In the same way, after learning this syllabus or after learning this course, what will you understand? That is nothing but course outcome. Okay, the first, this is according to the Bloom's taxonomy. So first outcome is to understand. So what do you understand? The first chapter I've told you, you'll understand the investment concept. So you'll understand the investment avenues which are available in the modern scenario. Next outcome is apply. So apply in the sense, you're going to apply the quantitative methods for this investment decision making. So in quantitative methods, it might be financial ratios or any kind of tools and techniques which help you out in order to decide on the investment, like what investment is good, how much should you make in investment, what is the right time for entry and exit. All these you're going to apply the quantitative methods. That is about its application. Then you have analyze. So analyze the factors of investment for real time trading. So I've told you about the economic analysis, industry analysis, company analysis. So these will all sum up and you'll be able to do real time trading. So whatever you want, whenever you want to make an investment, then this real time trading means actual application of investment can be made. You can start with 1,000, 5,000, how much ever you have, you can open up a demat account, and through that demat account you can get into the business, but it should not be like an addiction. As you're still learning, it should not be like an addiction where if you get lost then you're trying to recover it. That should not be the case. An amount specific limit should be selected and you make an investment in the stock market to understand this subject better. Okay, so the initial knowledge which is required to understand, we'll provide. Making an investment and learning further, that is up to you. Then the third objective is that is outcome is to analyze. We have finished. The fourth outcome is to evaluate. So evaluate the profitable investment in capital market using security valuation models and portfolio theories. So security valuation models I've told you about: constant growth model, two-stage model, three-stage model, H model, and also I've told you about the theories: Elliott wave theory, Dow theory. These are all the different theories and models through which you will be able to evaluate which of the stock is profitable, which of the debenture is profitable, on an overall, which capital market instrument is profitable according to your needs and requirements. And the last course outcome is to construct. So construct optimum portfolio investment for feasible investment plans. So each individual investor's preferences will be different. So I have told you initially only, some want safety, some need high return, some want less risk securities, some want hedge against inflation. Considering all these, you try to construct an optimum portfolio which is given by Shape. So in this optimum portfolio, you choose securities, you choose securities according to your requirement, place them, give them weightage, formulate them, and after formulating them, you will get the resultant as to which security has got higher return with less risk. Once you get that security, you give weightage to them according to your investment. For example, if you have 20,000, based on that weightage is given, or if you want to invest 50,000, based on that weightage is given, or else the whole amount, that is lump sum amount of 50 or 10 or 1 lakh, that is completely divided among that stocks based on the ratio retrieved by the optimum portfolio construction. So this will help y'all to understand in which stocks the investment should be made, how much it should be made, and what is the purpose. Oh, these are all the different outcomes which you get where you understand, apply, analyze, evaluate and construct. So this is a very important subject, very interesting and at the same time partially difficult, because if you're strong in your statistics and analytical skills, then the subject will be very easy for you, because this is not based on any format pattern. You have to read the problem, understand it, analyze properly, then you have to derive at a feasible solution. So again, the investment differs from individual to individual. Based on the client, based on the customer need, you have to design his portfolio. It will not be common for all. Some do it for the purpose of tax also. This is also one of the factor which you have to consider. So considering all these factors, it varies from client to client, customer to customer or person to person. So hope at the end of the semester, we'll be able to inculcate these outcomes and provide you knowledge for your survival. Survival in the sense for your future. And to sum up what we have discussed in today's class, we have discussed the college vision, college mission. We have discussed the department vision, mission. We have also discussed the course overview. What do you mean by investment? And what is the objective of learning this subject? And also we have discussed what are the different kinds of units you get in this course. And we have discussed the course outcomes which we will be able to inculcate in y'all at the end of this semester. Thank you.